headphones on your computer or to call in using your phone. You may select how you'd like to listen by clicking either the telephone or mic and speakers button in the floating box that comes up after you log in. Also in this box, you will see a tab called Questions. We'll be using this for Q&A. If at any point during the webinar you have a question, please feel free to type it in, and we will answer as many questions possible during the Q&A portion of the webinar. Please note we're also recording this webinar, and we will share that with you shortly after the presentation. So let's get started. I'm Saurabh Kohli, an associate with the Center for Financial Services Innovation. We're very pleased to welcome you all today. Also leading the session will be my colleague, Thea Guerin, a manager at CFSI. We're here today to present early findings from two upcoming CFSI reports on small dollar credit. One, high-quality innovations in installment lending, and the second, insights from CFSI's Test and Learn Working Group. Both of these reports are based on recommendations from the Compass Guide to SDC, but provide two very different views into this market. The first is a high-level snapshot of the practices and innovations being adopted by some lenders in the market, whereas the second report is more of a deep dive into specific case studies under 7 SDC strategies. Between these two reports, there are learnings from a very diverse set of installment lenders. Also joining us on the call today, we have guest speakers from the Test and Learn Working Group. Brianna Fabri, Head of Marketing with Innova, Guy Catani, the Director of New Market Strategy at Van City, and Luis Peralta, the COO of Nick's Neighborhood Lending with Connecta Federal Credit Union. All of us are very excited to share the findings about new innovations and improvements in small dollar lending. Small dollar borrowing is a very critical need for some consumers. With inadequate savings and limited access to traditional lines of credit, nearly 50 million people annually use SCC products for quick access to cash, which can then be used to supplement income, support a purchase, or cover unexpected expenses. Oftentimes, these consumers are facing very complex liquidity challenges. From the lending perspective, this is a dynamic time for the SCC marketplace. There are low interest rates, and there has been recent growth in installment loan products, which are multi-payment products. This seems to be part of a noticeable market shift as recent regulatory actions have curtailed the volume of single payment products, which include online payday, storefront payday, and overdraft protection. The industry is expecting the Consumer Financial Protection Bureau, or CFPB, to come out with their proposed SDC rules by the end of the year. Market experts foresee that the rule will introduce many borrower safeguards while increasing lender obligations. Most anticipate that these rules will have significant impact on the entire market. The two reports that we will be previewing today directly focus on installment lending practices, but can be relevant for all SDC lenders and should be valuable for non-lenders as well. The findings from these reports lead into discussions about promoting borrower success and providing opportunities for improved consumer financial health, which are both broadly applicable to all types of lending and relevant to other financial services as well. This is a key opportunity for you to think about how you can apply these learnings to your own products or businesses, or how you can promote them in the marketplace. We believe that the complete release of these reports will be very informative for the field. So let's quickly go over the agenda. First, I will provide an overview of the findings from our upcoming report on high-quality innovations in installment lending. Please note, this is such a fresh preview that we're actually still in the midst of finalizing our analysis, and this is only a working title. After I conclude, Thea will lead a discussion with some of the members of CFSI's Test and Learn Working Group. They will cover some of the main learnings from those pilots. Then, you will have an opportunity to have your questions answered by our panel. You can submit questions throughout the course of this presentation. Now I'd like to take a moment to acknowledge and thank our funders who have made this session possible. Funding for the Compass Principles and research on our small dollar credit projects has been generously provided by the Ford Foundation and Omidyar Network, with additional support from the MetLife Foundation for the SDC Test and Learn project. Now let's set up some background for our first preview. Drawing on our research over the last several years, CFSI has developed deep knowledge and expertise on small dollar credit, which are loans of less than $5,000 with terms ranging from 2 weeks to 3 years. In our earlier SDC research, we extensively documented the consumer need for small dollar credit. We conducted panel surveys on SDC borrowers and accordingly identified prominent consumer use cases. We have also done extensive research from the provider side, learning more about lending practices and design implications. You can follow this link on the slide, bit.ly/small-dollar-credit, to download these reports and to view other CFSI thought leadership on the topic. In addition to market research, we have also focused our attention on evaluating quality through our framework of the Compass Principles. For those of you who may be new to CFSI, we developed these Compass Principles in 2012. They are aspirational guidelines to ensure quality, innovation, and execution in financial services. The 4 Compass Principles are: embrace inclusion, to responsibly expand access; build trust, to develop mutually beneficial products that deliver clear and consistent value; promote success, to drive consumer behavior through smart design and communication; and to create opportunity by providing options for upward mobility. There are also 6 core values that underpin these Compass Principles. I'll highlight 2 in particular. The first is the firm belief that financial service offerings must be profitable and scalable from a business standpoint in order to offer consumers lasting, high-quality solutions. The second is acknowledgement that consumers' needs vary, and therefore there is value in variation and choice in the marketplace. CFSI has released several Compass publications over the last few years, which include product guides for prepaid, small-dollar credit, and payroll cards, as well as a prepaid industry scorecard. The Compass Guide to Small-Dollar Credit affirms that these products should be both profitable and designed for borrower success. The guide defines a high-quality small-dollar credit product according to these 7 guidelines: that it is made with a high confidence in a borrower's ability to repay. It is structured to support repayment, priced to align profitability for the provider with success for the borrower, creates opportunity for upward mobility, has transparent marketing communications and disclosures, is accessible and convenient, and provides support and rights for borrowers. Underlying these guidelines, the guide recommends core, stretch, and next generation practices. Core practices are the standards for a high-quality SDC product. A loan should not be considered high quality unless it meets these practices. Stretch practices then go beyond the basic requirements. And next generation practices are for providers who have met the standards of quality and are challenging themselves to stretch beyond the basics and are considering the next step in high-quality product design. The market truly needs leaders like this who will drive customer-focused innovation. With that context to CFSI's research, let's explain the first report. Using the Compass Guide to SDC, we conducted survey interviews with a sample of 16 installment lenders who have shown some adoption of high-quality practices. We assessed the features and practices offered by these lenders, not the specific lenders or the products themselves. In our upcoming report, we will have a snapshot of high-quality innovations in installment lending. We'll share findings from this survey. The report will also include innovation spotlights of companies that have adopted practices from the guide in particularly innovative ways. Many of the lenders we surveyed offered multiple SDC products. For the purposes of this report, we only surveyed personal installment loan products. Payroll-based products and collateral products were excluded from this report. This table summarizes the lenders we surveyed. As you can see, the sample represents a diverse group of lending institutions, including banks, credit unions, CDFIs, and other non-bank direct lenders. The sample was selected based on conversations with several market experts representing federal agencies, industry organizations, nonprofit policy and research groups, as well as CFSI advisors and the participating lenders you see here. Aside from the innovation spotlights that we will share, we do not report on specific lenders. All general findings are anonymous and assessed of the aggregate sample. Please note, this is an inaugural report. In future iterations of this report, we would like to capture more innovative installment lenders in the market, as well as the lenders of other SDC products. We encourage you to share your recommendations of lenders to include in future reports. Now that we've covered the background, let's take a sneak peek at our findings. I'm going to highlight some examples from 3 different practice areas: core, stretch, and next generation. Here are 3 core findings. Following the first Compass guideline about making loans with a high confidence in a borrower's ability to repay, all 16 lenders we surveyed collect personal information, employment or income information, and require proof of identity and address in their underwriting process. All lenders surveyed employ a proprietary underwriting algorithm or some score-based analysis to determine if a borrower qualifies for a loan. To incentivize and reward positive behavior, 6 of the 16 lenders offered to reduce the rates of their loans during the life of that loan for borrowers who demonstrate consistent repayment. With this practice, I'd like to spotlight Elevate's Rise Rewards program, which allows borrowers to receive discounts by earning points that are rewarded for positive behaviors or actions, including on-time payments, early payments, paying more than the scheduled amount, and completing financial education and credit courses. Borrowers receive discounts on their payments by reaching different points-based milestones. And along with the guideline about not relying on penalty fees and interest rates as profit drivers, half of the lenders sampled offer reasonable grace periods of 2 or more days, allowing consumers to avoid late payment fees and penalty interest rates. Here are some examples of stretch practices gaining traction in the marketplace. To structure loans that support repayment, lenders can design flexible payment schedules that better match the timing of borrowers' income flow with their debt obligations. 6 lenders surveyed have already adopted this practice, but there is more opportunity for this to become common in the marketplace. Traditional channels for submitting loan applications include in-store, online, or over the phone. 7 lenders give borrowers the additional option to use kiosks at retail locations to submit applications or to make payments, which significantly increases access and convenience for some consumers. Springleaf is a spotlight for this practice. They accept payments in branch, online, by mail, mobile, phone, and even at Walmart customer service desks. To minimize borrower risks with repayment, 2 lenders work with borrowers' employers to direct payments from their payroll. Opportunity Financial, or OpFi, is one of these leaders. And now let's discuss a couple of next-generation practices. Under the guideline of supporting repayment, 6 of 16 lenders send payment alerts and notifications before a payment is due via text or email to help borrowers better manage their debt responsibilities. Another next-generation opportunity is to promote savings opportunities and incentives to help borrowers improve their ability to manage future emergencies or cash shortfalls. 2 lenders in our sample offer a credit product that helps borrowers build savings. These 2 lenders, Freedom First Federal Credit Union and Guadalupe Credit Union, are in our innovation spotlight. These credit unions have been piloting the Borrow and Save loan, which was developed by the National Federation of Community Development Credit Unions. With this product, a percentage on top of the loan amount, either from 25% to 50%, is frozen in the savings account and is only available to borrowers with accumulated interest once their loan is paid in full. This is an early innovation that incorporates and incentivizes savings. There is need to further adopt and innovate strategies that help consumers who struggle to establish an emergency savings net. So that does it for a brief preview of the findings from the upcoming report on high-quality innovations in installment lending. To view the full report with complete findings, innovation spotlights, and analysis, please stay tuned for the official report released this October. A reminder, we encourage you to submit questions at any point during this presentation. So if you have any questions on some of the findings I shared or any questions on the upcoming material, please use the control panel interface to submit one. Now, I'd like to hand things off to my colleague, Thea.
Thank you, Saurabh. As Saurabh said, my name is Thea Guerin. I'm a manager at CFSI, and I'm eager to share with you some insights from CFSI's Small Dollar Credit Test and Learn Working Group on today's webinar. The Small Dollar Credit Test and Learn Working Group is an 18-month evaluation of high-quality small dollar credit pilots and features. The working group has been made possible by the generous support of the MetLife Foundation, with additional support provided by the Ford Foundation and the Omidyar Network. And the working group is really intended to achieve three things. First, it's designed to provide a safe space for providers looking to pilot small dollar credit products for features that are aligned with CFSI's Compass Guide to Small Dollar Credit. And while CFSI can't offer a regulatory safe harbor to these companies, we can mitigate the reputational risks of innovating in this industry by shining a spotlight on these companies and helping them to earn positive recognition for their work. Second, the working group is designed to generate a shared understanding of how small dollar credit products can meet the needs of underserved consumers. So here, we're really trying to understand the features, the functionalities, loan structures, and pricing design that contribute to a high-quality user experience. And thirdly, the working group is designed to encourage replication of successful products and approaches. So today on this webinar, this is the first of many opportunities that we'll be taking to leverage and showcase findings from this project. We'll also be releasing a white paper in September, along with 4 videos highlighting each of the individual projects, which will be followed by a series of blog posts in which we'll do a deeper dive into each of the individual projects. And at the end of this presentation, I'll be providing you with a link that you can use to sign up to receive these publications. So the 5 companies participating in the working group are listed on the screen. They are Connecta Federal Credit Union, LexisNexis Risk Solutions, Regions Bank, Innova, and Van City Credit Union. And each of the companies shown on this slide were chosen to participate because they have products and features that fit CFSI's definition of quality that's articulated in our Compass Guide to Small Dollar Credit, which you heard Saurabh talk about. These companies were also chosen because at the time of the working group launch in January of last year, 2014, each of these companies were introducing new products or features to market. So we were presented with a unique opportunity to observe borrowers' reactions to the new loan or feature that was being introduced. Finally, these companies were chosen because they represent a diverse group of institutions with a diverse group of solutions to offer to the small dollar credit marketplace. So Connecta Federal Credit Union partnered with LexisNexis Risk Solutions to provide alternative underwriting solutions for a payday consolidation loan. Regions Bank is piloting a savings secured installment loan with a reduced loan minimum. Van City Credit Union is piloting a payday loan alternative product that provides borrowers with quick access to funds. And Innova is piloting a payment selector tool on an installment loan that allows customers to choose the size of their payments and the length of their loan term. And of course, we couldn't have done any of this work without the assistance of the UNC Center for Community Capital, who we hired to collect quantitative and qualitative data on each of these projects. So without further ado, I'd like to turn our attention to our guests. And I'm so pleased that representatives from 3 of these companies could join us for today's discussion. So we have Guy Kutani from Van City, we have Luis Peralta with us from Connecta, and Brianna Fabry here with us from Innova. And I'd like to begin our discussion by asking each of our speakers to briefly describe their project, their company's rationale for offering this product or feature, and what each of them were hoping to learn by participating in CFSI's Small Dollar Credit Test and Learn Working Group. And as each of them respond, I'll be showing you guys a slide with account terms for each of the products and features to give you a little bit of background about each of these products. So Guy, why don't we start with you? And again, I'd like you to briefly describe your project, your company's rationale for offering this project, and what you were hoping to get out of participating in the working group.
Absolutely, and thanks, Tia, and good morning or good afternoon to everyone, depending on your time zone. So for us at Van City, what we've noticed 2 years back that there was more and more of our own members, and we're the largest credit union in Canada with about 500,000 members. More and more of our existing members were using or turning to high-cost fringe providers from payday lender and check cashing. And for us, we found it a gap as well as an opportunity. Here we have this untapped market segment that we can better serve and really deliver both impact as well as growth. So we started an entire new strategy around serving underbanked and underserved markets. Out of it came several products. One of those that we're going to discuss today is really about the Van City Fair and Fast Loan. It's a small dollar credit that's really designed from the ground up as an alternative to payday loans. So it provides quick access between anywhere between 100 and used to be 1,500 as shown on the slide, but it was recently changed to 2,500. API is 90%, and it can typically process within just 1 hour with a single account manager in our branches. So you go in, and if you meet those eligibility criteria within 1 hour, the money is in the member account. So it's a very fast, very convenient experience, and very inclusive. One of the things that for us that we're really interested in with the test and learn is that Vancity is the first institution in Canada to introduce a payday loan alternative. So there was obviously a large learning curve for us. And one of the ways for us to deal with that was basically to reach out to the CFSI network, and particularly to this research of the court, and learn from other financial institutions working in the space what works, what doesn't work, so we can really take those learnings, best practices, incorporate them back into our product, and deliver an even better member experience.
Great, thank you, Guy. Next up, Luis, why don't you tell us about your product?
Sure, thank you, Tia. In the case of Kinecta, we are offering these loans through our QSO, which is Nick's Neighborhood Lending. These branches are located in the underserved communities in the Los Angeles area. We know that in California there are about 1.8 million users of payday loans, and since these are single payment loans, the 3 major credit agencies don't take this type of payments history. So we decided to help these underserved families by providing them a payday consolidation loan that allows them to bring payday debt up to $1,000 into an affordable installment loan. We call it payday payoff loan, and we have 2 different tiers. One that is capped at 18%, and that's basically $200 to $499 loan. The second tier is following the NCUA payday alternative standards. For that, the range of the loan amount goes from $500 to $1,000 at 28%. They both come with application fees. In the case of the 18%, the application fee is $31.95. In the case of the 28%, the application fee is $20. These loans, since we're a credit union, we are required to provide membership, or these borrowers meet our membership requirements to have access to these loans. I think there's a big opportunity overall in the industry to help these underserved families with more affordable, responsible loans so that they can meet their cash flow volatility and their emergency. So that was the bigger triggers of our decision to deliver these solutions.
Thank you, Luis. Brianna?
Thank you, Thea, and good afternoon, everyone. I'm the head of marketing for NetCredit, which is Innova's U.S. personal loan brand. We market to near-prime consumers offering a mid-sized personal loans of $1,000 to $10,000 and over 6 months to 5 years at an APR of 35%. Our product comes with no additional fees, no application, origination, prepayment, or late fees. And we also offer the opportunity for consumers to build their credit history as repayments are reported to major bureaus. We were really excited about this opportunity to partner up with CFSI on the working group. As Sorhab kind of mentioned, in terms of the compass principles and some of the, core values, number 4, which is value and choice, it was really important to us. We completely echoed that sentiment that one size does not fit all. And so, as we thought about our product and how to bring the best options to our individual consumers, we, when we launched, started by offering consumers the flexibility to play with their loan amounts. So we would approve them for a minimum to a maximum loan amount that was suitable for, what state they were in, the regulatory environment, and also their creditworthiness. and then gave them the choice to choose the actual right amount for their needs. And so the opportunity for us was, that was a very well-received piece of the puzzle, and we wanted to go to the next step and also allow them some flexibility around choosing their payment amount. We had lots of kind of anecdotal feedback from consumers, some who wanted to pay more per reoccurring payment so that they could pay down their loan faster and get out of debt faster, and some who, of course, needed to kind of be more flexible and match their budget as their cash flow needs changed and be able to, address lower payments here and then, kind of adjust that as the course of the loan goes on over, up to 5 years. It's a long time, and obviously budgets and cash flows change. So we implemented this payment choice opportunity for consumers to kind of choose the payment amount and the corresponding duration and really customize things for them.
Thank you, Brianna. So my next question for all of you is, each of you recently introduced these products and features, and I was hoping that you could tell all of us a little bit about how and whether these products have been successful for your borrowers and for your institution. What indication do you have of the success of these products? And to the extent that you're willing, I'd encourage you to talk about the loan performance, take-up rates compared to your goals, any customer feedback you may have received. So Luis, why don't we start with you on this question?
Sure, thank you, Tia. Since we started the program, we have done about 4,500 loans. That's about $3.5 million in payday consolidation loans. We've been successful in terms of keeping the originations cost low, as well as the servicing for the portfolio. Our charge-off program to date is about 4.5%, which is extremely good for this underserved market. We know that most of these consumers, they have either no FICOs, low FICOs, or they have some bad credit history. So the fact that we are able to leverage alternative data to better address the credit worthiness and also the ability to repay these loans is helping us promote financial inclusion and also keep our portfolio profitable and sustainable. We've seen a huge, very positive feedback from borrowers showing great gratitude about the impact on their financial situation. For example, for borrowers that consolidated about 3 payday loans, that's $900, they have saved close to $1,800 in a 6-month period. And they have built their credit. A lot of them started in the low 500s, and after the 6-month period, they are on the high 600 and low 700. So it's a significant improvement in their financial health.
Great, thanks, Luis. Brianna, how about you?
Yeah, I think we have seen some great results from this product feature pilot. What I'll say, kind of on the most positive end, we've seen about 30 to 40% of our consumers choosing their preferred amount, so actually changing their, default payment amount from a number that we've sort of tried to identify as being the best option for them. But by giving them the choice, 30 to 40% of people are actually choosing a preferred amount, and about 60% of those are decreasing their amount, and 40% or so are increasing their amount. So that's really positive, I think, in terms of just seeing that there are a lot of people who are going to either, to either choice. And the great news is that of all of those people who chose their preferred payment amount, what we are seeing is about a 50% reduction in first installment delinquency rates. So I think, it's somewhat safe to say that it's working when consumers are given the choice to kind of choose the right amount to fit their budget. They're more invested. They're really able to choose something that is going to work for them in terms of repayments, and so that's really helping bring their delinquency rates down. Obviously, that's great not only for the consumer but also for the business. So we're really excited by that. We've seen about a 10% reduction in call due rates and a 14% increase in average expected customer lifetime value. What we're working on now is really trying to find the optimal way of presenting customers with this choice, and potentially being able to increase the uptake rate of all the consumers who are able to kind of make a choice for themselves. So sort of playing with the balance of how do we identify the best option for them, as well as also promote their opportunity to make that choice for themselves.
Perfect. Guy?
Yeah, so I think for us, Advanced City, the product actually really exceeded expectations. When we first started this initiative, we weren't entirely sure what was the result was, because again, the underbanked, underserved segment was a brand new segment, both for us in Advanced City and in Canada as a whole. But from a member perspective, our key goal was really to develop an offering that developed, as the name suggests, truly fair and fast, fun access to the members. And I think we're able to do so with a product which is only 19% APR and takes only less than an hour in our branches. I think even more importantly from the member perspective is that to date we were able to sell in just over a year 1,100 of those loans, which we estimate save our members over $2 million in fees and interest if they will charge or take typical payday loans. So I think that's kind of direct impact to our members, literally giving money to people who need it the most. And what we're also seeing is that by doing surveys with our members, most of those were able to break the payday loan cycle. So we're taking one fair and fast loan, so we're able to replace 5 or 6 payday loans that they were taking every year. From Advanced City perspective, our goal was basically to have a product which is a very core, we have mortgages, we have line of credit, and now we have the fair and fast. We want to have something which is scalable, so not just sell in a few dozen or few hundred, but we potentially can sell a few thousand, and we are getting there. And also to make something which is financially sustainable. So to date, our losses have been lower than expected at a low single digit. I think the other thing for us, and we didn't expect it so much, was really that because this offering was the first of its kind in the Canadian marketplace, it received unbelievable media attention and industry attention. So we had dozens of media stories, great feedback from members, from the public, from the regulators, and we even just received the National Innovation Award for the credit union system in Canada. So I think all of those, in addition to serving that particular segment, really help us support our brand as very progressive, inclusive, innovative, and almost serve as a differentiation acquisition tool for us as well.
Fantastic. Thank you, guys. So then moving on to my second question, clearly each of you has articulated the success of your products and features. I'm curious if you could expand a little bit on why you think these products and features have been so successful. So Brianna, why don't we start with you on this question? And you started to talk about offering consumers choice and flexibility. Could you talk a little bit more about how you think this really came into play with the payment slider tool?
Yeah, absolutely. So I think, again, I mentioned we had plenty of anecdotal feedback from consumers, as we were looking at sort of reasons why consumers, say, didn't take the loan, didn't kind of complete their application or decide to proceed. A lot of the feedback we were seeing was related to, well, the payment size doesn't work for me. And again, I saw, consumers saying both sides of the picture, that some of them felt like they wanted to pay down faster. Obviously, they always had the option to do so. They could make an extra payment at any time. They could prepay without any penalty. But I think a lot of people kind of feel like, that they want to sort of have it set up for them, right? Not everybody wants to think about every month, okay, I need to add some more. I want to pay down this, this loan faster. How much more can I add? It's a lot easier. It's obviously much more convenient for people who are busy and constantly on the go to have something that's just scheduled, that they can set an automatic payment for and not worry about it and just know that it's, taken care of and that it's fitting their needs. So I think there was definitely an express request from our consumers to have some of that flexibility, but obviously we don't want a one-size-fits-all product. We know that certain people are going to want to pay it down faster, and certain people are going to need the flexibility to pay it down slower and to pay less each month to better fit their budget. We also know that certain consumers, as I said, will have different cash flows over the life of this loan. Sometimes they'll be able to pay more, and sometimes they'll actually need a little bit of a help where maybe somebody loses a job, or there's an unexpected expense elsewhere and they won't be able to make that same payment, and they just need that ability to play around with their number but still continue to be a on time, current, and very good customer of ours. So that was, I think, the real key for us was being able to put it in the consumer's hands. And I think in terms of that act of giving the consumers control, I mean, some of the other things that we're seeing just behaviorally that show us that there's some real success to this, we've seen a 20% reduction in the time to actually complete the application, in the back half, where we say, okay, you're eligible, here's what you're eligible for, go ahead and choose your loan amount and your payment terms, and then sign your contract. There's a 20% reduction in the time that it takes consumers who choose their own amount to actually complete that process, which is surprising, right? Because they're the ones that are actually taking the extra moment to think about what do they want. But what that told us was that by putting things in their hands, there's a degree to which you change the way they think about this offer. You are able to increase their investment with the product and with the brand. You're able to kind of increase their engagement and really get them to sort of have a very positive experience of feeling like they're in control, and that will go far beyond just any kind of good customer feedback, but it actually has a real-time impact in conversion rates and delinquencies and things that are going to be very beneficial for both the consumer and the brand.
Fascinating. And Guy, in your previous answer, you started to talk about your marketing campaign and the earned the media that Van City received on loan. Could you expand on some of those thoughts, please?
Yes, absolutely. So I think for us, one of the key successes for Fair and Fast is that it wasn't a standalone product that we just developed and launched to the marketplace, but it was really an outcome of a key strategic priority to develop a strategy for the underserved. So in that sense, it was a very holistic offering. So we had process and technology and product features working very closely together to deliver a very member-centric experience. But we also have this holistic envelope of change management, market positioning, and reporting. So specifically on market positioning, that's something that we had many discussions on. And for us, it was kind of finding a careful balance between something that really appealed to that segment. And I think you can see it from the name, Fair and Fast. So really address the member needs for fast and convenient access to funds. But we also wanted to make something that really resonates with our other 90% quote-unquote well-served members that doesn't alienate them and saying, why are you providing that kind of segment? So I think that was kind of the balance for us. And I think we've done several focus groups to really kind of nail the branding and the positioning. And with the end result, we're actually so proud of it that we actually put literally our name there. So the product is actually trademarked as the Van City Fair and Fast Loan. That was as far as the marketing campaign. And I think earned media was also very beneficial for us, especially in the first few months of the product when we didn't need external marketing because of budget constraints. Earned media was a very powerful tool for us to really get the message out there to the members and even to the industry that's saying that there is this problem and here we are here developing and delivering a solution. So it was very effective, and once the story came up in the media, we literally saw our uptake triple essentially overnight.
Perfect. And then Luis, how about your loan? You guys, I know when we were sifting through the results of this project, we noticed a lot of positive customer feedback on various features and aspects of your loan in terms of loan design, structure, and various policies. So could you speak a little bit about the design of your specific product?
Sure. For example, some of the most important features is that we match loan due dates to payroll cycles. We give them a window before we charge a late fee. We make sure that when they come to the branch, and this is one of the biggest challenges that we have faced, is a lot of these customers have a timing issue. They just want the product that they're used to, and they many times they're not open to listen because they are not familiar with installment loans. So it takes time to educate them about how that works and what are the benefits. Sometimes it takes 2 or 3 times for them to listen to the information and bring either their spouses or some other relatives that could help them ask more questions and better understand the product features. But the good thing is that over 90% of the customers that have taken the payday payoff, they haven't taken a payday again. So that's a very positive outcome of this effort. In terms of the product design, I mean, it's a fully amortized loan. So at the end of the term, they owe 0. We are reporting these payments to the major credit bureaus, so they are building credit as they pay these loans. And the interest rates and the overall financial cost of our products is significantly lower than what they have with the payday loan, so they are building savings at the same time.
Great, thank you. So then, I'm wondering if the 3 of you guys could talk a little bit about some of the challenges that you faced with the launch of these products or features. And I'm happy to let anybody start out answering this first.
Sure, I can jump in. I think certainly one challenge that we've had and that we've been actively working through over the last number of months, it's great to say you want to provide consumers with choice, but we also, I think, all know that too much choice can be overwhelming. And I think we perhaps found with our first implementation of the payment selector tool that maybe we went to that place, to the too much choice is overwhelming place, where we were giving them so many options to consider that some people felt that it was overwhelming and that it was perhaps not a decision you can make. I think we've all been to the supermarket and you see 9,000 cans of soup and you don't know which one to buy anymore, when all you went in with was one very simple idea. And I think that's certainly a piece of the equation. So we've been working very diligently over the last few months to sort of take this idea, evolve it. We've been doing a lot of user testing. We've been going directly to consumers to test out different ideas and ways of presenting them with this choice and the options, and really trying to figure out what is the best way of offering choice and how are we going to really make it easy for consumers to get engaged and get invested. And I think we recently rolled out a revised presentation on our website for the payment selector from the one that you briefly saw on the screen before. And right now we are seeing a good uptick in conversions, which is very exciting and very encouraging for us. So I think that's been a really good process and evolution for us to kind of go through on this journey and learn more about our consumers and what's the best way to interact with them.
Perfect. Luis, how about you?
Well, as I mentioned earlier, customer education about installment loans is a big challenge. A lot of times we get the comment that what's the catch? This is too good to be true. Why are you doing this for us? So it takes time to really go over that barrier of disbelief and just lack of education, financial education. The other big challenge is to customer acquisition. As you know, in LA, mass marketing is extremely expensive, so we rely on community organizations and other partnerships to really get the word out. So that's been taking a lot of time. The good thing is that with the close to 4,500 borrowers and families that we have helped already, that is picking up a lot of the word of mouth. So they are bringing other friends and other people that also have payday loans, and that's really helping increase our loan production in the last couple of months.
Great. And Guy?
Yeah, so I think for us, most of the challenges were primarily internal. So I think for Vancity, this was our first major entry into serving the underbanked and underserved markets. So we had many discussions at the executive and the board level about what is the right business model, can we make it financially sustainable, and again, the marketing positioning piece that I mentioned earlier. So that was kind of a key constant challenge that we were kind of trying to address and evolve as we were exploring this segment and launching those offerings. The other key challenge for us was Vancity is currently in the progress of replacing our core banking system. So that's obviously a major enterprise priority, which puts lots of constraints on what you can and can't do with the system, and of course, a draw on resources. So we had to work around that constraints as well.
Perfect. So at this point, I'd like to turn to some of our audience questions, which have been coming in steadily, and I'd like to take this opportunity to remind our listeners to enter any other questions that they have on the screen to their right. We likely won't be able to get to all of the questions, but we'd be happy to follow up with you after the webinar. The first question, though, that I'd like to put to, I believe this is for Luis and Guy, is whether the products that you've been describing with these relatively low APRs, whether you think of them as loss leaders or whether they're profitable. So, Guy,
Sorry, in our case, Kinecta and Next Neighborhood Lending, this is a product that must be sustainable and profitable by itself, so it's certainly not a loss leader. That's why it's important for us to keep control of the four main drivers of cost, which is acquisition, origination, servicing, and charge-offs. So we're making sure that we are looking at all those four factors to make sure that this is a profitable and sustainable product.
Yeah, and for us too in Vancity, keeping the offering as financially sustainable, that was one of the key mandate or objective of our initiative, particularly for the fair and fast loan. It is financially sustainable. Obviously, the margins on small dollar credit products, whether the APR or this and that, are limited. I think for us, it was financially sustainable because we were very, very careful in making sure that the delivery process is very efficient. There is only one handoff at our branches, and it only requires less than an hour. The other piece for us on the repayment side, the repayments are very, very good. Again, like over 90%. Losses are in the low single digits, so very sustainable on that regard as well. And I think the other piece for us, because Vancity is a full-blown credit union, then we also have a long-term view on that, in the sense that as we help members when they have emergency, and we help them with a small dollar amount, and we help them rebuild their credit history, and we are there for them in the time of need, we actually gain stronger and more developed members who can then apply to other core products such as car loans and lines of credit, and maybe in the future even mortgages. So even the potential revenue from those members is now dramatically increasing because we were there for them when they needed us.
Perfect, thank you. And Brianna, you actually mentioned that there was also, you guys observed a change, an increase in the lifetime value of customers that use the payment slider tool. So can you speak to this question at all?
Sure. I mean, certainly, there's I think with the opportunity to choose your payment and get invested and so forth, what we saw was that consumers were less likely to be delinquent, which obviously is going to, result in an increase in the lifetime value for us just by that factor alone. But I think what we've also seen is, as I kind of mentioned there, that they're more invested not just with that particular loan, but with the company, and the brand as a whole. And so I think there's, a lot more opportunity to continue to be the right partner for those consumers, over a longer period. So in terms of, being able to continue providing, them with additional opportunities for credit in the future, and I think that idea of being a right partner is one that has popped up for us from some survey work and other opportunities that we've looked at as being very important to our consumer base. These are consumers who are looking for an actual company and a brand to, be partnered with, not just fast cash whenever they need it. These are people who are looking for somebody that they can rely on, somebody that they can have trust in. And so I think that opportunity to be the right partner for them, is also a piece of the equation.
Thank you. Another one of our listeners would like to know whether any of your products require customers to go through a financial education course or an online financial fitness course.
In the case of Connect, we don't require for them to take those classes, but we provide the access to it. We have a partnership with Savvy Money that provides free credit score monitoring service and also a budgeting tools that allows them to improve their financial health.
Yeah.
Same with. Go ahead,
guys. Go ahead. Okay. So I think for us, Advanced kind of this issue of financial advocacy, financial literacy, is something that it was kind of a key issue for us during the design. And when we did the focus group and discussed with many members, I think something that came very clear for us, at least for our own membership, is that when members have a financial need, they really want you as their financial partner to be there to support that need versus, make it mandatory for them to receive financial literacy or, quote unquote, provide them with kind of a lecture. And we also saw that piece, and some members perceive it as being a bit more, a bit judgmental if every time they come and they have financial needs, we have to make it mandatory for them to get the financial literacy. So basically what we're doing is that we don't so much as make it mandatory during the initial phase when we just there to address the member needs and provide them with the funds, but as we are a few months later, when we have another opportunity, another touch base with the members, then we see if the member is now open to have a more discussion about their objectives, their goals, and the financial situation, and then we can really inject those elements there.
Perfect. And Brianna?
Yeah, I think similar with NetCredit, we offer financial literacy opportunities for our consumers, and we're really excited about that opportunity and some of the results that we're seeing. None of it is required, however. It's all optional, and it's just there for the consumer's benefit.
Perfect. And let me get in one last question from one of our audience members. And that question is around the CFPB's proposed regulations that will affect the small dollar credit industry. And the question is, how do you think these regulations will affect your institution and the future of the credit industry? So this question is mostly for Luis and Brianna, because Guy, you guys have a different set of regulators in Canada.
Well, in the case of Connecta and Next Neighborhood Lending, our loans are significantly below the 36% threshold that CFPB has proposed. So those regulations most likely won't apply to us. It's going to be an impact in terms of financial credit availability. So one of our biggest concerns is that we might have some capacity issues, and that's why we want to make sure that both in the short and long term, financial inclusion and credit access is not affected.
Great. And Brianna?
Yeah, I think you know, we're very encouraged. I think by the CFPB looking, you know, towards ability to repay. I mean, that's something that we feel like we have been, you know, doing, you know, well before this ever came up, since the launch of our products. But obviously, we're you know, very much on the same page with them in that regard. I think the key is going to really be that, you know, we hope that this helps narrow the playing field a little bit, I guess, so to speak, to the companies, you know, that CFSI has mentioned here today, to my colleagues and so forth, you know, where we are lenders who are really trying to do the best job possible to provide consumers with access to credit, to, you know, still be there. As we all know, access to credit for these consumers is critical, and they can't be left without any options. There has to be an option for them, and I think those lenders who are doing the best job possible to make it clear and transparent, to make it easy to repay, to provide additional opportunities for upward mobility. I mean, what we hope is that the CFPB rules help promote and you know, expand on those lenders and those opportunities, while eliminating the opportunity for some of the more, you know, unscrupulous lenders to kind of prey on the market. And I think overall that will be the best possible outcome for this industry.
Great. So with that, I'd like to thank our three guest speakers, Guy, Brianna, and Luis, as well as all of our listeners and webinar attendees. And I'd also like to encourage all of you to sign up to receive alerts about the release of the 2 reports that we described on this webinar, as well as additional updates and reports and research from CFSI in the small dollar credit space. You can do that by registering for the link on the screen. And as a reminder, the Test and Learn report will be released at the end of September. Again, it'll feature case studies about each of the 4 working group members that will be organized under a series of about 7 strategies. And the SDC Innovations and an installment lending report that Sarah mentioned will be released shortly thereafter in October, and should provide some really interesting insights into the small dollar credit industry as a whole. And finally, I'd like to remind you that a recording of this webinar will be emailed around shortly, so I encourage you to share this with your colleagues. Thank you so much for your attendance.